Thanks for having me again. Welcome everybody. Glad to be here again. I think I was here last year, so it's always fun coming up to Fargo here for Big Iron Week and able to throw this event in as well. So again, I apologize. I'm going to have some of the repetitive messages that we just heard. So good to hear some of us are on the same page. So appreciate that. And I must have a timer. I apologize. But we'll try to keep going, and I'll try not to repeat too much, but some of those messages I think are very important and that they're heard, and you do what you can to help make your farm successful as well. So we're going to talk about the market impacts and farm operation planning in a volatile environment. I think everybody will agree it's pretty volatile right now. Lots of things going on in all of the markets that impact agriculture, not just the commodity side, but inputs and other things as well. And we're going to talk about what tools maybe are out there and that we can use to help our farms be successful. So what's going on today? Obviously inflation, right? We've heard that, we've beat that one enough. Increased interest rates, increased inputs, lower but still high commodity prices. We have come off the highs obviously, but we're still at relatively high prices to where we've been if we look at the last 20 years or so. And then I'm going to talk about some new and old tools for a bigger toolbox. We just have a bigger toolbox today than what we've had in the past, and so we'll go through some of those things as well as we get into this. So first, I always like starting, where have we been, where are we at today? And the drought monitor, I know not everybody agrees with what the drought monitor says, but it is definitely a gauge that we can use to see where the moistures are at and where some potential issues are with some production. So looking at the 2021, we know where we were, right? At the end of a year ago, I think this is September 14th, a year ago, the drought monitor for 21. North Dakota, northern Minnesota, severe drought. And we saw that in production, we saw that in yields, saw that what ended up going in the bin wasn't a lot. And so we struggled there going into the winter. What could we possibly end up with? 2022, obviously spring, wet, right? All of a sudden we're talking prevent plant. So going to the worst droughts we've got across the state of North Dakota into prevent plant in the spring of 22. And where do we sit today? Now drought has, ironically, there's one state that I want to double check this, but I'm pretty sure every single drought monitor that came out in July, there was one state in the lower 48 that did not have any drought in it in the month of July, and that was North Dakota. The only state in the lower 48 that did not have drought in it during the month of July, which is very abnormal for us. We usually have at least some. Now you see it has snuck in a couple different areas in North Dakota as well in southern Minnesota. And we all know we are still dry. We did not get a lot of rain, a lot of areas here at the end of July into August. August makes beans. So it'll be interesting to see what some of our soybean yields are. But, right now we're sitting on the dry side. They're talking rain tomorrow, right? Let's hope so. Hope we get some. It might not cure the crop or fix the crop other than some sugar beets will probably really like it and maybe get a little more test weight on corn. Our tillage equipment might appreciate it. We could use a little moisture just to help with that tillage equipment as we go into the fall here. So just again, kind of seeing where we've been, where are we at today. Who knows? If we can go from extreme drought a year ago to prevent plant this spring, we don't really know what's going to happen with the weather. Kind of like us marketing guys. We don't know what's going to happen with the markets either. I heard that, I think it was today over at Big Iron. Somebody said, I can honestly tell you, as somebody who studies the markets, I have no idea what's going to happen next because nobody knows what's going to happen, whether it's geopolitical, whether it's weather, who knows what it could be. We don't really have any idea what's going to happen next, but we'll give you our best guess. So inflation, I'm going to talk about this just a little bit here. Here, we're looking at basically inflation, and then we take out I think it's the red line takes out the food and energy just as a different measure to see where we've been. And obviously inflation since 2020, we've seen a little bit of a recession, basically COVID driven, short little recession. The grayed areas there you can see are recessions, technical recessions that are marked there, what happens. But inflation now has come up since 2020. Again, we heard report this week over 8% again. We're hearing about an emergency meeting of interest rates going up because of it, because they're trying to curb it a little bit. The Federal Reserve's goal is 2%. Their long-term goal inflation is 2%. So here in that 8% number gets obviously people a little concerned. We don't want to go too much higher than that, but I'll show you here in a little bit where we have been. So right now they're aggressively fighting the inflation with current policy, and we'll see what happens if they do this emergency meeting and an emergency increase of potentially 0.75 or even 1%, and yet still meet again in November, talking another possible increase in interest in that, and we'll get into that here in just a second on the next slide. So here's something similar. Again, this is a little longer span, going back to 1970, a little bit before 1970. Again, those gray shaded areas are recessions. And so you see what happens to interest rates during a recession. During a recession, normally interest rates are a little bit higher and they pull them down. And so if you look back to where we've been since 2010, actually a little bit, basically the 2008 recession, what happened? The housing bubble, interest rates basically crashed. They took them down to basic, in theory, zero. They weren't technically, but they were just about zero. And you saw that we held on there going all the way up until about 2016, where we started slowly creeping them back up. So slowly getting the interest rates back up. It's just one tool that the Fed uses to help control inflation and overall economy and what's going on. But you can also look back at where we were in 1980. There's a lot of chatter at Big Iron, a lot of chatter in the ag industry. Is this the 80s? Well, in the 80s, we were already, before going into the 80s, you look at 70 into 75 there, we were already close to double digits. We quickly got into double digits as we got closer to 1980 and saw that 17 to 19% Fed funds rate. Again, this is the interest the banks have on the Fed funds, so this is not what you pay on the farm. Yours is in addition to this. And so you can see where they were at as far as the Fed funds back in the early 80s and what happened there. We did see, a couple of recessions there, and we all know and heard the horror stories. Coming from a lending institute, I hear about the 1980s. I was not a loan officer at that time, but I've heard about it and heard plenty of stories. So very good reasons to be concerned. A lot of things are looking at that, but will it be that? Most people are saying no, we don't have the 80s because, number one, we don't have the interest rates there. And we're a long ways from 15% interest, and there's a lot of things that could happen. If we get there, there's probably a lot of other issues as well. So I'm not too concerned with it, but it's on the radar. Let's put the interest rates and inflation together. If we look at those two together, what do we have? So this is just kind of putting those two charts over the top of each other. In this case, the blue line is the inflation number, again, excluding the food and energy. And basically, you can see it really follows along, right? Inflation starts to go up. There's some action, something done, or the economy just goes as it does, and it corrects itself. That's what kind of free market does. It'll correct itself. Obviously, some influence here with interest rates, but as we go into those recessions, or we have the inflation going up, interest rates go up as well, and then unfortunately, a lot of those times, not all, a lot of times they end up coming back down during a recession. Recessions aren't always bad. They're obviously tough for some, but it is a correction to the market. It's a way to get us back to where we need to be successful as an overall economy and moving forward in the right direction. So I'll direct you to the far right. You can see there again where the inflation, again, the blue line going up here the last few years, and the sharp increase in interest rates. Well, one thing about inflation, I don't have it here because I don't have the food and energy included in this chart, but the Fed is more concerned about deflation than inflation. And deflation is really hard to get out of because, in theory, inflation means what? Everything is going to be more expensive tomorrow, right? So we want to spend today because it's going to be more expensive tomorrow. In deflation, people stop spending. People stop spending because the value of everything is going down tomorrow. So why would I buy that land? Why would I buy that tractor? Why would I buy anything? Because tomorrow my dollar is going to buy more than it does today, and that is just a spiral downward effect in an economy. And so the last thing we want is that. So they're very careful to make sure we don't get into a deflationary state of mind, and so they're also going to because of that, they're going to be more cautious in the inflation market too, because they don't want to drive it down extremely fast. Although they're being very aggressive on the interest rates. I think we've heard that already. Everything's relative. Our prices where we're at for the commodities relative to where we've been the last few years are pretty good. Even though we're off the 12-month highs, they're sitting pretty good. Our interest rates, I was telling somebody when I became a loan officer, I had to do all I could with prepayment penalties to get us below 10% interest rates. And so where we're sitting today, again, relative isn't a bad spot. It's just higher than where we've been the last few years, and it's kind of what we're used to. We have short memory sometimes on those, but things we need to plan for, and we need to be ready because it's a real thing. It's a real expense, and we're going to see increased costs in the interest that we have any kind of operating or variable rate that we don't have fixed. So again, I mentioned low rate environment. We've been low rate for 15 years. There's a lot of young farmers, and I will also say loan officers out there that have never experienced higher rates. And so they don't exactly know, how that's going to affect the farms, how it's going to affect the bottom line. And so it's things we need to be aware of. We're in that transitionary period right now. Again, I said the Fed is expected to continue to act on this until inflation drops. The question is, will they get us all the way into a recession or not? And that's, everybody has their own opinion on that. Can we come off of a high inflation without a recession? It's possible, yes. And so it'll be how much will they move and act to do that, with, I would say, a fairly heated midterm election coming up. Nobody wants to ruffle too many feathers either. And so I think the Fed is going to be very careful, but yet I think they'll do the good job and focus on what's right for the economy. But I think those are some things to be considered. Is the last thing anybody really wants is to go into a recession, especially right before an election year, or election period. So we'll see what happens there. Where do we end up going? So increased costs. I talked about this a little bit. So this is a tool that we have as far as it actually works on a crop insurance product that we sell. But what it does is it tracks your projected price this time of year, because you're planning, as Brett just mentioned, we're planning for 2023. The fertilizer guys are out there trying to lock in fertilizer. The seed guys are out there trying to lock in seed. You're possibly looking at new land rent or maybe even buying land. So it's the early stages of planning. So I look at, okay, if we're going to look at the projected price, and this is the 22, so this would have been a year ago. So let's take it back a year ago if I was standing up here talking to you guys. Projected price in this example was corn and futures corn in Chicago. Now what you get at the elevator, because there's basis and we know it's going to be different, was at 506. And that was traded from August 15th to September 14th. It takes that whole average. And so sitting there, it was 506 in the futures market. Are we able to make money on that? Urea, again, this is down in New Orleans, so it's not what you're paying at your local co-op. Obviously, there's transportation to get it here, plus there's handling costs, plus obviously your local co-op has to make a margin of some sort as well. So that's what I would call basis on the inputs, so that's going to be higher. But this is just looking purely at a traded market that gives us an idea of what's happening. And so urea there at 452 a year ago. You can see where DAP, potash, diesel, I won't go through all the numbers. Obviously, in interest rates. At that point, we're looking at about 6.2% interest, again a year ago in September. Now the harvest price. So the harvest price looks a little bit different. I said now comes April, we're going to plant the crop, even though I know we planted late May into June in some areas. But now all of a sudden we're locking in these prices. We could have locked them in September. You come to April. Now what are the costs? What are the actual costs? Again, we're using the same markets here. So there you can see urea went up about $300 a ton. DAP went up over $300 a ton. Potash, that's its own little thing. It doesn't really trade, so it doesn't follow that. It doesn't change that from one to the next. Diesel, you can see also we saw a huge jump. Again, we're now the harvest price side of this, we're looking at April, with the exception of corn and interest rates. In this example, we don't look at the interest rates or corn until October, because that's when we actually harvest and we'll get the revenue of the corn. And the argument is we'll have interest probably charged on our operating loan up until we get that crop harvested and can get some cash. And so those are open yet, but currently, I think this was yesterday's, we were $6.96 for new crop corn futures, and we were $9.57 on the interest rate side of it. So what does this really mean? You can see the drastic increase. These increases in this example, I think, was corn in Cass County. If you net this out to a per acre based on estimated, the costs went up from September when you planned to put the crop in the ground till April when you're actually going to put the crop in the ground. Your cost per acre went up about $140. And I think Brett even mentioned about $150 increase from year over year. That was just from planning last September until planting season this year in 2022. So where do these come from? Again, this is that diesel. I kind of have the square box there that's shaded. That's that discovery period I just talked about. So again, last August into September, and then once we come into April, you can see what that market did on the diesel. We were fairly flat until we got into February. Then things got a little hectic. Well, what happened? Lots of things happened, right? But one of the bigger things, Russia and Ukraine. And there's all some disruption in the market in many aspects. So again, we can see where diesel really spiked in April because what was going on. DAP as well, that started to spike a little bit early. Right in once we got into February, see where that took off. Again, I shaded kind of those areas where I come up with those numbers on both sides of that at the beginning and on the end. And I think I got urea here. Urea actually started coming. Urea came down in April. It was starting to come down. For the scare of prevent plant, we had, an excess, had a little bit of, not overproduction, but we had all the urea in the States, and it was a matter of where's it going to go. And we had plenty of prevent plant acres of corn this year in certain areas, especially in North Dakota and others, so we became a little bit of an excess supply, and we've seen that market come down as we got into the planting season, and I believe continued into June. And here's the interest rates. I said we're not tracking that yet because we have to wait till October, but we can really see now what interest rates done. Now, before we get into that tracking period in October, what you would be, if you're paying interest on your operating loan today, you have another month or two before we possibly get that crop and turn it into cash. I already mentioned we could see at least one, if not two, possible interest rate hikes, and again affecting our costs, and that'll add to our expenses as well on the input side. So those are things to be considered. So again, I show you that. Here's also that commodity price. And again, Brett touched on this as well. If you start looking at the bottom left where it's corn, basically a $3 swing in the market if we go back a year. Where did it go? What did it do? Top right, the soybeans. What was that? I think was that $3 as well. The numbers are even small for me to see. So, but a huge swing there, and then of course the spring wheat being the big one, where we see the largest swing. Again, this is just looking 12 months. This is just looking back. We kind of need to know where we've been to see where we possibly could go going forward. This whole thing could happen again. And like I said, I kind of got marked the highs, and then you can see where we're currently at as of yesterday. I believe these charts were put in here. But again, we're still relatively high to where we've been in the last 5 years. And so we're at good places. The problem is those inputs seem to be coming up as well. 2012 was another really good rally in the markets, and what happened? Our inputs got really high. How long did it take for the inputs to go down versus the crop commodity prices to go down, right? The commodities came down a lot faster than your inputs did, and it's a lot more liquid market. Again, some of that, we got funds in there moving things around too, and they're coming in and taking a profit as well. But so these are things we all need to be concerned about, is these commodity prices won't be here forever. We're going to have swings up and down, and it's just a matter of, can you capture the opportunity? We talked about some tools already today to help capture some of that opportunity, but some of the other tools I'm going to talk about, we also need to help eliminate the risk of your inputs as well. And so there's a lot of different ways to do that, and we'll talk about that here in a little bit as well. So overall, just looking at 22 versus 23, again, so this example has to be Cass County corn that I pulled. I already went through the one on the left was 2022, where you can see the corn, urea, DAP, and diesel and interest rates, where those prices have gone up over the last 12 months. On the right is 2023. So on the right side there, the projected price is where we're currently tracking all of these markets today. And today was actually, today's the last day that'll be added. I don't have those added in these numbers yet, but it'll be your 30-day average. Where are we at? So right now, if I'm planning to plant corn, I can look at $6.09 futures, again, before today's market, is where we were trading on an average. $6.69 is where urea is at, DAP's at $7.34. So just look at where we started a year ago on the left to where we're at today, that projected price. The harvest price on the right is 2023. That's basically the current market or what it's traded. So corn has already, in the last 30 days, seen 23 cent increase. Again, it's a rolling average, that projected price, where the harvest price is just a matter of what the futures are. but you can even see urea's up as well, DAP is up as well. Diesel's actually down just a little bit, not much. Interest rates, even in that 30-day period, the average is lagged back about 20 basis points or so. And what will it do going forward? So these prices, projected prices, will be locked in here today once we add today's market movements, and those will be then locked in this tool of essence to help protect some of your input risks and costs going up, affecting your margin going into next year as we plan. So again, things to keep an eye on, make sure you watch that. There's obviously other ways. You can always market, you can always go to the elevator. Again, I already said the fertilizer, the seed, those guys are out there locking these things in. We can lock prices in cash-wise as well. So there's different tools to use. I just encourage you to pay attention to where these prices are at, where they've been, and what is your risk appetite? What do you want to make sure you get locked in going forward? So what does this all mean? So what does this really mean for you? Inflation, I talked about the earlier 08 through 14. We had ag inflation. It was tight supplies, right? Obviously the 12 drought on corn, things like that. We really cut back on our supplies. And we had increasing demand and it kind of leveled off there. But now we're really seeing uncertainty in supply and demand staying strong. I mean, we don't know what's going to happen. We've talked about Europe. We've talked about Ukraine and Russia. You know, what could possibly happen with China? China is obviously our biggest demand right now for soybeans. A lot of chatter at Big Iron about, you know, the soybean plants going up. Obviously, there's some chatter about some new ones as well as some that are breaking ground and some that have already opened. What will that do for our demand? We learned with the trade that China can be a bully. And if they don't want to buy our soybeans, they don't have to buy our soybeans. They can go to the outside market, South America, find it. And North Dakota, we learned our lesson. I hope. I mean, we put a lot of our eggs in one basket, and when they decided to shut the doors, we talked basis. You saw $2 basis, $2 under basis or more, or even off the board on soybeans. How are we going to keep this demand going? We look at different avenues, and some of these crushing plants are great ways to do that. Obviously, that leaves us with excess soy meal that we need to find a market for as well, potentially, and that can lead to other discussions. Family living and other expenses are going to be higher. Inflation, everything gets more expensive. It doesn't affect just certain people, it affects everybody. We all go to the grocery store, we all buy groceries, we all fill our cars up with gas or fuel. Everything is just more expensive. There's a lot of tough decisions on what to buy now. I talked about inflation. It's going to be more expensive. Everything's going to be more expensive in the future until this inflation stops or slows down. We have seen certain markets start to pull back a little. The surprise yesterday that inflation was higher than what it had been the month before. And they were expecting inflation to go down at least a little bit. Again, at 8%, they're hoping to get it, sub 8% because of what fuel has done, and fuel has softened in some of these other markets. But the fact that it didn't, that's kind of where it surprised the market. And then we all felt it in our 401ks, right? We all felt it with the stock market yesterday. So there's still a lot of, with all that being said, there's still a lot of cash out there. There's still a lot of cash. We hit COVID and a lot of things changed. There's a lot of programs, lots of other things out there. And we've had some good marketing and some good opportunity in ag, but there's cash out there. There's land sales that, people can't find equipment to buy just because there's no supply of the equipment. So there's that extra cash maybe that instead of buying equipment, they put it towards a land sale. And all of a sudden we've seen some land sales of recent surprise many of us in the quick increase in the value of what they're purchasing compared to what we've seen just 6 months ago. With that, I think the industry is a little bit different on the credit perspective, that when we are doing loans and lending on real estate, we do require a little more cash down than what we did in the 80s. And so they have to come up with the cash, and they're doing it. The people buying the land have had the cash, and they're able to put a good chunk of cash down, so that makes it a little bit easier on the finance side. I think that was a duplicate. So what's different than the 80s? bring up the 80s a handful of times here today. So what's really different than the 80s? Here's the biggest difference. We have such a large toolbox to help mitigate risk. We have a much better understanding of hedging tools. The cash, do you even understand as simple as a cash contract? My dad had a grain elevator for it was about 16 years in the late 80s through the 90s into early 2000s, and we just didn't have a lot of cash contracts early on. And as we got closer to 2000s, we started doing it a little more, and farmers were just a little more comfortable. Still concerned, because what if they don't raise the crop, right? They don't have the bushels to sell. So just the understanding of how this works in the cash contracts, futures, we have people like Brett to help us understand futures and options, things like that as well, tools there that can help better educate us and know what we're doing if we utilize those tools, know the risk of it, as well as the potential reward and the protection that we have. That's much more popular being used today than it ever was in the early 80s. There wasn't, in some of these, we didn't have the options markets out there in the early 80s to do this. So those things have evolved. Hedge to arrives, again, is just another way to utilize the futures market at your local elevator. And in using those hedge to arrives, again, I saw Brett utilize that in one of his examples here today. Those are tools that are out there that help you, the farmer, mitigate the risk going into harvest and knowing what you got. Input prices can also be locked. I didn't spend a lot of time on that, but you can look at the previous summer, so now, or going into fall, I guess technically, but they were out there in August trying to get you to lock in prices. You could lock in some fertilizer prices and get that lower price. Fall applied, get them right after you get done harvesting, get them to apply some of our areas that works better than others, but we can get it applied in the field. That helps the possession. That's the concerns is, are we actually going to get it, whether we have the contract or not? Will we actually get the physical product? Well, if we get it fall applied, we know we have the product. It's out there, it's in the field, and it's available. As well as winter discounts. I call them the flash sales, the end of the year. None of the tax preparers like me to say this, but obviously tax planning, we need to spend some money. A lot of times fertilizer is one that people look at. And can we buy some? The agronomists out there, they know that, so we have the flash sales, kind of the sales at the end of the year. Hey, lock in your fertilizer, let's get it. Here's your discount, so we can get a little more discount. But again, you're locking that input, so we've taken some risk off the table by doing that. We also have crop insurance products, these revenue insurance products to help us protect. Just revenue protection alone helps protect your price and production losses on the revenue side as well as your actual production. If we have an issue there, we can do it. It allows you to market that crop before harvest, having that pre-harvest marketing plan in writing and put in place, and then following it, we can go up to our guarantee on the revenue protection side. And if we don't have that crop, we can use the funds from the revenue to buy out of the contracts we maybe got into. So again, a better risk management plan than what a lot of farmers, and I would argue the vast majority in the 80s, plant and pray. You put it in the ground, hope you have it, and then you also hope you have a good price when you harvest it, or when you do need that cash, you're able to get a good price for it. Much more out there, however, it does take a little more planning. Margin insurance protection price, it helps protect price and the inputs. Those are those examples I had. That's a fairly new concept. Not a lot of chatter on that. It's only been around for a handful of years. But in today's marketplace, it's getting a little more interesting because, again, as I mentioned, we can lock in our inputs as well as our revenue basically out in the market. You can go to a broker and do the exact same thing by buying options, puts and calls on both sides of that. It's going to get a lot more expensive as you have to pay the premium for those options. This is a way that we can possibly do that and do it with, it's still a premium, it's still a crop insurance policy, and there's a premium to it, and it's not cheap, but again, it's all in one, and it's all one math calculation. You just need to look at your premium, what your margin is, and do it. I do have a question in the room.
What is the sales closing date on those margin products?
Great question. Sales closing date on the margin products is actually the end of September. So September 30th, you need to make that decision if you're going to buy it or not. And so you need to talk to your insurance agent fairly soon to get that figured out if that's a product for you. That's a great question. Appreciate it. But yeah, again, that's locking in your margin based on national markets is what I would call it. It's not your local co-op. It's not what you're paying cash for. It's not yours specifically. And the yield in there is based on an area plan, so it's based on your county. But again, most people are relatively close to how their county goes as well. So Again, all these tools in our large toolbox that we can now utilize. All right, what kind of actions for the farmers? This is going to get a little repetitive from our previous speaker here. Know your numbers. Be proactive. Explore the options. Review the insurance plans and manage your margins. You really need to dig into it. I know it's hard and it's not an exact science. We're not going to know the exact cost of production today, looking at 23, but we got to get close. We know those prices, anything we do today isn't fixed unless we do something and utilize one of the tools to help lock it in. So then we know it's a little more concrete, but we need to start somewhere. So explore what your options maybe are, what tools you maybe are interested in using. And I just always say, be proactive instead of reactive. If we're going to be reactive to the market, that's the 80s. We're going to be reactive to the weather. We put the crop in when we can in the 80s. We're going to get what we can when we harvest it. That's just waiting for it to happen, as opposed to being proactive. Put your numbers in, figure them out, get your tools ready, and move forward. Every farm is different. I'm not going to stand up here and say there's a one-size-fits-all. It would be the easy button. I think it was Staples always had the easy button. We always loved the easy button. That's not the case. Everybody's got different risk tolerance. Everybody's balance sheet's a little bit different. You know, how much they're willing to risk, how much they can afford to risk. But manage what you can control. What's out there's a lot of things out there beyond our control. I can't tell you if it's going to rain too much in the spring. We can't tell you if there's going to be a drought next year. What we can manage is, how am I going to be protected if I have a crop, if I don't have a crop? What prices can I look at? We can lock crop insurance prices in now basically 10 months out of the year. You don't need to wait till February. You don't need to wait till February to lock in your crop insurance price. You could lock it in today. You could lock it in today based on where it closed yesterday for a premium. Nothing's free in this world. It costs money. But how much risk do you want to take off the table? If you know where we're at today at $6, 606, whatever the number was, you can lock it in today if you want, if you're willing to pay the premium. We'll wait and see what happens in February, but you could lock that in. And so just know where you're at, know what your operation is willing to risk and what's not wanting to risk and what's willing to pay to eliminate that. So what's your business plan? We talk about this a lot too. A lot of things have happened over the last few years, from tax changes, estate tax, things like that. I really look at family, this one's on a timer as well, I apologize. But your family business or entity that you're using, communication is key. You need to make sure everybody is on board. Everybody's on the plan of, what is the marketing plan? What is our risk appetite? What are we all willing? Everybody involved who has some skin in the game here need to be part of these conversations. What are the tools we plan on using and maybe why? What tools are we willing to look at and use? And I heard it earlier, an exit strategy. Sometimes you just have to have an exit strategy. What are you going to do to get out? Where are we going to go at what point in time? When prices get to a certain level or yields or things like that, what's our exit strategy? Again, knowing the why as well is so important, whether it's multiple generation or just brothers or cousins or whatever it is. Knowing the why are we doing what we're doing. Explaining to everybody the why is, we see these entities or operations struggle when we know in our head what we're doing and why. But we haven't explained it to maybe our partner or our son or our father. Maybe the next generation's doing the marketing and they didn't tell the older generation why they did a certain plan or why they bought a certain kind of insurance. Explain the why, make sure everybody's on the same page. You don't always have to agree, but if you understand why you did something and you made that typically is okay then. When something does blow up, it's probably not nearly as bad. And having that plan for the future. What is the future? What is our goals for the future? Where do we want to go from here? What does this farm look like in 5 years? Are we going to grow? Are we going to expand? Are we going to stay where we're at? Are we going to add another generation? What are we going to do 5, even 10 years? We have a retirement in there. What's that plan? How's that look? Takes time to get those things through. And that time is your friend. The shorter that time, the more expensive it can get. You can dissolve an entity or you can dissolve a farm very quick, but you got to get a checkbook out and pay for it. And so I think that's really a big part of it as well. Make sure that you are knowing what everybody else wants and what the strategy is so that you can plan accordingly and get ahead. And I'm guessing I'm just a little bit early here, but we probably have some time for more questions if there are any. So we've both completely put them to sleep, or we've answered everything they possibly could have wanted to know. Move on. Thank you very much.